What was previously regarded as safe haven money by nations worldwide has now become another desolate currency. Yes, I'm referring to the Japanese yen and how it is collapsing. In June, the Japanese yen reached levels versus the US dollar last seen in early 2002, continuing its fall. At the same time, you could be sitting there and believe that this is a Japanese-only issue. Sadly, you are mistaken. As much as the yen's free decline causes issues for Japan, it also negatively affects the rest of the world, especially the United States. Hello everyone, and welcome back to our channel. In today's video, we'll talk about Japan's worst crisis in 20 years. So, stay until the end of the video to learn it all. Compare the US dollar. The Japanese yen dropped to levels last seen in early 2002. The ship's size impacts the domestic economy since import prices based on the yen are increasing at a record yearly rate, putting strain on household balance sheets. In an unusual joint statement, the Bank of Japan and the Japanese government indicated that they might step in if the situation continued to be weak. The impact of the weakening yen on larger financial markets has been relatively small so far, but that might change if the sell-off picks up speed. The third most traded currency worldwide, the yen, is now close to 134 per dollar after beginning 2022 at 115. The yen is expected to have its largest yearly decline since 2013 as the dollar has increased by 16% so far this year. The widening interest rate spreads between Japan and other countries are the main cause of the weakness. The Bank of Japan, BOJ, has stepped up its accommodative policy approach as the rest of the globe, led by the U.S. Federal Reserve, is actively raising rates to rein in skyrocketing inflation. While the gap with German yields is at 8-year highs, the difference between the yields on Japanese 10-year government bonds and those in the United States is 279 basis points, close to a 3.5-year high. Well, the government gets involved in the pressing question. They most definitely mean what they say. The recent severe drops were the strongest warning to date that Tokyo could act, according to the Japanese government and central bank. The yen recovered swiftly from its lows over the past 2 decades, but not everyone is convinced that meaningful intervention is inevitable. Japan has generally concentrated on halting strong currency increases and adopted a hands-off attitude to yen weakness due to the economy's dependence on exports NSE -0.67%, which makes it more challenging because yen buying requires Japan to use its limited foreign reserves. When the Asian financial crisis prompted swift capital outflows from the region in 1998, Japan last intervened to support its currency. Before that, in 1991 to 1992, Tokyo stepped in to stop yen declines. Given how challenging it is to modify the yen's value in the international foreign exchange markets, currency intervention is expensive and prone to failure. The BOJ dovish position may change if GDP prospects significantly improve when the nation reopens its borders following COVID and inflation rises. For the first time in 7 years, Japan's core consumer prices in April were higher than they were a year earlier by 2.1%, exceeding the BOJ target of 2% inflation. If the BOJ adopts a hawkish stance, the yen's decline could come to an end, according to Francesca Fornassari, head of currency solutions at Insight Investments. Any indication that interest rates outside of Japan are at their high could also spark a relief rally. However, given that futures markets expect U.S. interest rates to peak at 3.5% in mid-2023, there are currently no indications of that. To help Japan's growing trade deficit, the yen has fallen back to recent 7-year lows against the Chinese yuan and is currently hitting new multi-year lows against the Korean won and the Taiwanese dollar. Currency weakness, according to others, is essential for Japan's economy to preserve its competitiveness as a reliable source of supply chain diversification, like John Vale, chief global strategist at Nikko Asset Management. The yen's depreciation also increases the appeal of its stock market to international investors, who think it is undervalued compared to the European and American stock markets. Although they are still declining as investors worldwide sell riskier assets, Japanese equities have outperformed their competitors in 2022. The yen has long been the preferred currency for investors engaging in so-called carry trades, which entail borrowing a currency with a low yield like the yen to invest in a currency with a higher yield like the US or Canadian dollar. According to Refinitiv statistics, borrowing in yen and investing in an equal basket of dollars from the United States, Australia, and Canada would have produced a 13% return so far in 2022. But the rapid decline of the yen and concerns about government intervention are making investors uneasy, particularly as short bets against the yen approach 6-month highs. Further turbulence and weakening might make it less desirable as a funding currency. Japanese investors are in a bind as a result of the yen's decline. Since yields are high and steadily increasing, foreign bonds are becoming considerably more alluring. However, it also means that the price of FX hedging is increasing. Therefore, Japanese investors can frequently only benefit from the higher rates if they purchase unhedged international bonds. However, investors find it difficult to stomach such currency risk, such as the rising yen, given the current weak levels. The yield advantage would be erased if we made even a small move back to where we were 4 months ago, between 115 and 120. If the BOJ is correct, and they can ensure a cycle of steady price hikes, they may be able to ignite the much-needed growth engine in Asia. If they are incorrect, they'd run the possibility of a major currency experiencing an erratic fall, forcing the BOJ to make last-minute changes to its monetary policy and push Japan into another recession. Furthermore, they might not have much time if the speculative selling continues. Fast money funds are congregating around the struggling currency, but their positions are in no way enlarged, indicating that bears still have the potential to swarm in. A wider sell-off in Asian currencies may be sparked by the weak yen and another significant market factor, a more prolonged slowdown in China. The combination of persistent risk aversion, weak economic fundamentals, and relatively dovish central banks could result in sharp portfolio outflows from the area, favoring the high-yielding safe haven dollar. In comparison to its developed counterparts, the Japanese yen is likewise under pressure. Following the ECB hawkish tilt, it has fallen to a low versus the euro of more than 7 years, and after a larger-than-expected rate hike in Australia, it is currently trading at its lowest level against the Australian dollar since 2015. Any indication that rates outside of Japan are peaking could bring about a support rally. The constant increase in energy costs is another difficult element. A further factor affecting the yen is the fact that Japan imports energy. According to the recent movements in oil prices, Japan's trade imbalance could widen even more, which would put additional upward pressure on the dollar-yen exchange rate. According to Commonwealth Bank of Australia strategist Carol Kong on Bloomberg TV, our study suggests that the dollar-yen could rise to 136. The popularity of the Japanese yen hasn't completely waned, though. Zach Panel, a strategist at Goldman Sachs Group Inc., sees two possible scenarios for the yen to strengthen soon, either due to a change in central bank policy or intervention or due to a downturn in the U.S. economy. According to Marinov of Credit Agricole, one point in its favor is the possibility that Japanese investors may use the chance to sell off their remaining dollar assets and repatriate their earnings. Even while the sell-off reminds people of previous financial crises that might help stop the spread of the problem. We are undoubtedly dealing with a very cheap yen at present, and if the sell-off persists, the FX devaluation will exacerbate the stagflationary headwinds already affecting the Japanese economy. However, it remains to be seen if these events might lead to a genuine economic disaster. Benefits aside, what could stop the yen from free plunging if the government doesn't step in is likely the last thing that comes to mind. It's difficult to say, but the Bank of Japan's dovish approach may change if GDP prospects significantly improve as the nation reopens its borders following the conflict, along with increased inflation. For the first time in 7 years, Japan's core consumer prices in April were 2.1% higher than they were in the same month last year, exceeding the Bank of Japan's 2% inflation target. Suppose the Bank of Japan changes course and adopts a hawkish stance. In that case, the decline in the value of the yen may come to an end, according to Francesca Fornisari, head of currency solutions at Insight Investments. Any indication that rates outside of Japan are peaking could bring about a support rally. Although the U.S. rates are expected to peak at 3.5% in mid-2023, there are now no signals of that. Future market predictions lead me to believe that, like many other things, we will have to wait and see what happens in 2022. However, the Japanese situation proves one thing. Numerous factors affect currencies and economies, and events beyond the United States may impact them. Precisely in the nation of the rising sun. It remains to be seen if the yen will continue to decline and impact the global financial system, or if it will increase and surprise markets. With that, we've come to an end. See you next time. Goodbye.